Good morning and welcome back to Almus Market Mornings. I'm touching back on a narrative we discussed yesterday, and that's because the AI-driven sell-off has intensified. The heart of the issue is the disruption being anticipated by investors due to AI. So basically, if software development or the way people code has already changed because of AI, and Anthropic's recent update on contract reviews for legal work has instilled more fears of disruption. This has, of course, percolated to all geographies. We saw our own Indian IT stocks tumble quite significantly in yesterday's trading. Coming back to policy, today we have got the interest rate decisions by the ECB and BOE, both widely expected to keep rates unchanged. And on the geopolitical front, there is some easing after Iran confirmed participation in negotiation talks with the US. Good morning, JK. So we are seeing equities get a beating. Gold, silver, after stint at recovery, are finding it difficult to hold major levels like $5,090. Both are down significantly today morning. Currencies broadly remaining in a range. What do you think is cooking?
Good morning, Swaraj. I think we are in a place where market is unsure which way we're going because, as you also explained, the IT influence, or rather the influence of AI on IT sector, is still being reassessed, and including all regions. Of course, it's very relevant for India as well, which is of course trying to recover on its exchange market and the stock market based on the trade deal, the budget, and also the one with the EU. But this is a new challenge. So I think markets are on actually reassessing what's going to happen. And if you look at the stock markets, the valuations are still a concern. And if there is a challenge to the software sector or the IT sector from the AI developments, and that's going to put some more pressure on the stocks to correct, and that is something the investors will keep watching. We are having a continuation of the jobless growth in the US yesterday, as evidenced by two reports. ADP was disappointing, with only 22,000 jobs created, compared to a downwardly revised 37,000 in the previous month. Now, the policymakers, of course, do not seem to be overly concerned with the jobless growth because they are keeping a cautious eye on inflation. At the same time, we had the ISM services, which was holding quite well, coming at the same level as last month. And of course, the ISM services has been giving a good picture on the expansion side for quite some time. But the respondents have somewhat expressed their concern about the impact of tariffs, and this is also because the annual contract renewals are coming up. So we have jobless growth in the US, and I think policymakers' response is going to be neutral, at least for now. And while that is on, the focus is also on MPC, the UK rate decision, as well as the European Central Bank rate decision later. Both the regions have shown better economic numbers. Inflation has moderated in the Eurozone. In fact, yesterday's inflation number in Europe, and the flash number showed slightly less than what was expected. But I don't think that's going to sway the European Central Bank towards any further easing. Yes, the market will look out to see whether there is any dovish touch to their statements, particularly from the president, ECB president. UK, as usual, is more, concerned with the inflation number, was slightly higher last month. Even the GDP number was better. So both the central banks are likely to keep their rates, unchanged. And as usual, we will look at what hints we get from their forward guidance. Apart from these two events, we also have, the challenger job cuts. The JOLTS data that should have been announced on Tuesday will be announced today from US. And the government has also said that the unemployment report for the month of January will be announced on next Wednesday. So this delay has occurred because of the temporary shutdown of the US government. Now, importantly, where the dollar is, or is headed, is something that the market is still grappling with, because we have already seen a sizable two-way move in the year. Official comments have been contrasting. Trump's statement had indicated that administration is okay with a weaker dollar, but Treasury Secretary said that a stronger dollar policy is very much in place. Eventually, what matters for the dollar is how the US assets perform. So long as the bonds and equities continue to give good returns, overseas investments will continue into the US, because that's an outperforming market so far. And of course, the investments are most likely from select countries, because there are some countries which are also, reducing their bond investments in the US. So the question is how the assets perform in the year. This is again being reassessed in the light of the latest AI developments, and also the valuation concerns that is ongoing as far as the US is concerned. Yes, asset markets have had mixed performance so far this month, and the dollar also retraced most of its losses of last month. It's on the watch. Then we also have the geopolitics, which is ongoing. Iran, US stocks are also on the anvil, which is being watched by the market. So the dollar, I think, is currently lacking direction. Even the precious metals, about which you mentioned about their retracement, I think both the silver and gold had touched their Fibonacci retracement levels after the big fall that they had seen. And that's where I think the short-term players are probably taking some profit on the longs created at a very attractive low levels that they had fallen to, more due to technical reasons than fundamental reasons. That's the reason why we have seen some small retracement today. Yeah, I think now, it, as shared earlier also, I think we look at more of a two-way movement in these metals, because there's a lot of buying that has already happened, and dips will be definitely seen as opportunity for long-term investors. And at the same time, having seen the kind of meltdown that we can see if the market in a market that is overly long, investors will be cautious about also taking profits whenever there is a sharp rise. For India, we are at a stage when long-term investors are assessing whether the recent budget and trade deal with the US and EU will lead to improving corporate earnings and U-turn in the external macros. Situation is definitely better related to what it was 6 months ago, uh, with the now rupees weaker, which is attractive for the exports, and also undervalued. Stocks had a long-term, long time-wise correction, and budget has enough incentives for long-term investments. At the same time, we have a fresh challenge to our IT sector as a fallout of the AI development. So it's going to be a selective investment, and more like FDIs rather than the secondary market investment from FIs in view of the current valuations. For currency, what matters is whether the central bank is aligned with a stronger rupee, with exporter sector performance expected to improve, but not yet. In my view, rupee should continue in the higher range, until there are visible signs of improved exports and flows. From a medium-term point of view, looking at the commitment of 500 billion of imports from US as part of the trade deal, even assuming it is spread over 5 years, how the trade deficit will evolve is also another question. So if it is going to be a replacement of energy imports from other countries to the US, then it may not be impacting much. But if it is going to be some additional goods, then you could have a negative impact, further negative impact on the uh, trade deficit. I think there are a lot more questions than answers right now. So I think the rupee, I think there is no case for rupee to rally in a big way unless we see some bunched up inflows or something. Also, the central bank may also be looking to rebuild reserves to offset their large volume of forward short positions. So I guess we are looking at a rangy scenario between 18 and 50 and 92. Both levels are outliers, and more like 90 and 91.50 that we should be in for some time until clarity emerges on various questions. That's it. So we have, of course, some more economic events lined up, particularly from Europe, US, and UK, which the market will observe. Meantime, Japanese elections are also on the cards. So how the Japanese yen moves, there seems to be some difference between the BOJ officials who are concerned with a weaker yen on inflation. At the same time, the Kachi government seems to be more intent on fiscal spending, and that could actually weaken the yen. So there's a clash between these views. So how this will play out is also another question. So a lot of questions for the markets. So I think that keeps the a broad market in a range. Thank you.
Thank you, JK. And yes, a lot of uncertainties. And of course, you mentioned a very important point on the Japanese election. Interestingly, JK, something that might be of interest is that Takaichi government is actually having a good approval rating with the millennials, mainly because the Prime Minister herself is a great drummer. So she and the South
Okay.
Korean president, they when they met, they had like a drumming session together,
Okay.
and they're having a good PR in terms of with the youngsters. So that is for after a long time, there's a prime minister in Japan who is uh, getting that kind of approvals with the younger generation. So
Okay.
that's something
Interesting.
yeah, yeah, that's something interesting.
Yeah.
Otherwise, yes, as JK mentioned, asset markets having mixed performance. Dollar has also retraced most of the losses of last month. Gold, silver continue to see two-way movement, and geopolitics will be closely watched. That's it from us today. Thanks for listening. We will catch up tomorrow with a fresh round of updates.